When I graduated from university with an internship lined up right after, I felt like I was winning at life. You know, it's so hard to find employment in general, but it's even harder to get employed when you are a fresh graduate. So I was super excited, even though I was basically getting paid 5,000 rands a month. And for anyone who's ever lived in Cape Town, you know that 5,000 rands a month is nowhere near what you need to actually survive. You know, rent alone would probably cost you 5,000 rands, and that's just for a room sharing with other people, if that gives you a picture. So in all of this excitement, I started my job, things were going great. But after I got my first paycheck, I also got told that we were getting retrenched, which means they no longer needed my services and I was now unemployed. Biggest shocker. Like, I never expected to experience that, but that is exactly what happened. And that situation was quite traumatic, but it also taught me a lot of things. For this video specifically, what's relevant are these three things. First of all, job security is a myth. I feel like that job just taught me straight out of the gate that jobs are not here to stay, they're not guaranteed. The fact that you have a job today does not mean that you will have a job tomorrow or the next day. And that's such an important lesson to learn, especially as a young adult, when you're starting out with working. You know, it's just knowing that there is no such thing as job security and that you should always have your options open. And the second thing that it taught me was the fact that I needed to learn a lot of things, because when you get retrenched in South Africa, you can actually claim unemployment because every other month you've been paying this tax. Essentially, it's not a tax, but it's a contribution to the UIF, which essentially ensures that when you get retrenched or your employer lets you go, you can actually go to the UIF and claim unemployment, and that money really does help you while you are trying to look for your next job, right? And I did not have that information. I don't know if they tried to explain it to us when they were retrenching us, but I literally just do not remember having that conversation. So I just did not know that I could actually take my retrenchment letter, go to UIF and claim unemployment. So I didn't do that. I just suffered for months and months, not knowing I could have easily gone and claimed some kind of unemployment from them, right? So that's lesson number 2. Lesson number 3 that I learned is that financial freedom and financial flexibility is so important, because when I lost that internship, I was literally completely stranded. I had no other options. I didn't have a side hustle going. I had nothing. I had no savings, nothing. Granted, I just started working, but it just taught me that lesson early on to say, remember, you need to save, you need to make sure that you can take care of yourself if one day your job just disappears. So those are some of the things that I learned from that whole experience. And that ties into how I want to retire early, and that ties into some of the points that I'm going to be discussing in today's video on how you can also retire early. Remember, this video is in collaboration with Nozi, Talking Money with Nozi. I am linking down in the description to her channel, to the video that she did as part of this 2-video series that we're doing about financial independence and early retirement in South Africa. So I'm not going to do a deep dive into what FIRE is specifically, because Nozi already covered that on her channel. Please check it out, like I said, after this video. But I am going to give you a little bit of an explanation of what it is so that you can walk through this video understanding exactly what we are talking about. I said FIRE stands for Financial Independence, Retire Early. This is essentially a movement that tries to work towards reaching a point where they are financially independent and they have the option to retire, and usually retire before the normal retirement age, which in South Africa currently I think stands at 65, if I'm not mistaken. So if you are in the FIRE movement, those people are working towards reaching a point where they're financially independent and have that option to retire even as early as 30, 35, right? So that is what FIRE is, and that is a movement that I am obviously obsessed with. This is what this platform is built around. This is the motivation for what I do. So in this video, I'm going to be sharing with you how you can also join the same movement and work towards your own financial independence, because it is not rocket science. So the first thing that you need to do in order to work towards financial independence is to learn to live below your means, because that gap that you create between your income and your spending is what you're going to actually use to positively impact your net worth, because that money is the money that you're going to be able to use to pay off debt. It's the money that you're going to use to save and invest in two different ways actually, or you can do it in both ways, and that is reducing your expenses or increasing your income. Both are fantastic and they work even better when you combine them. So look at your budget, look at your spending. Where are you spending your income? Where's your money going, right? And once you have that picture, then you can actually start deciding on how you want to spend your money going forward, right? So you might find that because you haven't been tracking your spending, or because you haven't been budgeting previously, you've been spending a lot of money on takeout, for example, or you've been spending a lot of money on Ubers, or you've just been spending a lot of money on random little things that end up adding up, right? You can start being very intentional about how you want to spend your money going forward. So you decide exactly how you want to spend your money before you even get it, right? So that when it does come along, you already have a plan, you know what you need to be doing with your money in order for you to be able to spend less than you earn. And once you've reached a limit, because you will reach a limit in terms of reducing your expenses, for example, because you can only do that to a certain point, right? Because you don't want to necessarily just focus on cutting back all your expenses to the point that you're not necessarily living a full and happy life, right? So the other side of things that you are going to have to start looking at as well is your income. So for most people, you'll have a 9-to-5 job that you get paid for every single month, and the good thing here is to try and add more income streams, right? It's cool, it's great if you have a 9-to-5 job, but like I said in my story, it's very, 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 very risky to decide to rely on a job, because no job is guaranteed, like I said, right? So you want to make sure that yes, you want to keep your 9-to-5 income, but you want to start thinking about ways of actually increasing it or adding more income streams to it. So when you think about increasing it, you might think about things like getting a promotion if there's a promotion that's up for grabs at your workspace, or you might think about maybe switching companies, because you will get a higher raise when you switch to a different company than you would when you're within the same company typically, right? So that is another option to explore, and another that will probably take a little bit more effort than the previous two is to actually switch your career altogether. And this is something that I did because it just made sense in terms of the future prospects I had with my previous career, right? So I jumped to a career where I felt like I could do something that I enjoy, that doesn't make me want to pull my hair out, and still get paid enough money for me to do the things that I actually want to do with my life. So you might consider doing a career switch, especially if the career that you're considering will put you in a space where you can actually earn the kind of money that you need in order to live the lifestyle you want to live, as well as to work towards financial independence together. So those are two things that you need to think about, but definitely I think it's very important to combine those two methods of reducing your income while you're still reducing your spending, not your income. We always want the income to go up, but reducing your spending and increasing your income. It's a great combination and it works so well over time. And specifically speaking towards the FIRE movement, towards people who want to retire early and want to be financially independent, this group of people actually try to save quite a lot of their income. It's starting from at least 50% of their income. And it's really unrealistic, especially for most people, to start off saving and right off the bat start saving 50% of your income, right? So do not feel pressure to start saving 50% of your income. Instead, work towards that as a goal, right? Like I said, we want to save, but we don't want to save to the point of self-deprivation where you're not necessarily living a happy life, right? So if you can only afford right now, based on your income, based on your expenses, and based on how you've optimized all your finances, you can only manage to save 10%, then do that. Save that 10% and make it a goal to actually increase that, right? Because once you've done everything that you could right now in terms of reducing your expenses, which is the first point of call, like we said, then you want to start thinking of ways to actually increase your income. And increasing your income isn't necessarily something that you can just do overnight. It will probably take a little bit of work, a little bit of time. With controlled expenses and high income, you will be golden. So just start with whatever amount that you can afford right now and make it a goal to actually increase that as time goes on. Like I said, once you reach like 50% savings rate, that will be like life-changing, believe me. So that is the first thing that you really need to do if you are working towards financial independence. So the second thing I want to talk about a little bit cautiously, because I don't want to say that there is bad debt and good debt, because honestly, to me, it's all just debt, right? It's just debt. You've borrowed money that you need to pay with interest, right? That it's just debt. It really just becomes bad debt based on how we use it, are we abusing it, and all of that kind of comes in, right? But there is debt that has insane interest rates. Like if you went right now and got like a bond, right? And someone else went and got a credit card from a bank, the person with the credit card is going to pay a lot more interest on that debt than someone who went and got a bond from a bank as well, right? And that is mainly because the person who got the bond, there's a fixed asset, the bank can go and claim that house if anything goes wrong, if the person fails to pay. But with the credit card, it's very hard for the bank to reimburse itself based on your credit card purchases, right? You can take a credit card and fly to the Maldives and have the time of your life and come home, right? There's nothing for them to claim back if you can't pay off that money that you spent. And that's why they tend to charge such high fees. And I think in South Africa, they're really, really high. I think the last one that I saw was it like 20%. I don't know if I'm exaggerating, but that was just insane to me. So those are called consumer debts or consumer credit. And that's where you get charged the most interest. My point here is there is no such thing as bad debt. You just have to be very smart about how you use it. But it is definitely a good idea to avoid consumer debt that doesn't necessarily play in your favor. I know in the US, they always talk about how they get points from their credit cards, but that is not very common in South Africa. I think we get like fuel promotions and things like that, but it's not like substantial enough to justify getting the credit card just to get the benefit, if that makes sense. So just be responsible how you handle debt is very important if you are going to achieve financial independence. And if you already have consumer debt that you've been ignoring or that you just haven't necessarily put a lot of effort into paying off, it's a really good idea to start sitting down, understanding how much you owe, understanding the interest rates of the things that you owe, and starting to put together a plan to actually pay off that debt, because that will actually play in your favor in the long run in terms of you achieving financial independence. Because the amount that you're going to be paying on a credit card debt, for example, is insane. The interest rate is insane. It's nothing that you would get on the stock market, right? If your credit card is charging you 20% interest and you're investing on the stock market and you're getting 8%, the 20% cancels out the 8%, right? So it really doesn't matter. You might as well just try and get the 20% out of your life so that the 8% can actually make a difference in the bigger picture. So really try and avoid consumer debt. If you already haven't, make sure you have a plan to pay it off, and just make sure that you're not necessarily just taking out lines of credit that you do not need. And a good thing about being on this journey to financial independence is that because of the way you'll be managing your money, you will have other avenues to explore when you do need money out of the blue. That's another thing that people use credit cards for, is to respond to emergency situations. But if you are working towards financial independence and you're saving and investing your money, you most likely definitely have an emergency fund, so you don't necessarily need to like turn to credit in order to respond to an emergency. And those things really help you out when things like are not going well, in a way that doesn't put your finances in. The other important thing that actually I should have mentioned right at the beginning of this video is you need to figure out how much you actually need to be financially independent, how much you need to retire, right? And that means trying to guess what your future expenses are. It's kind of like an unavoidable thing, but there is a study that will help you figure out how much you need to actually retire, and that is called the Trinity study. It is a great rule of thumb to follow just at a high level in general, to help guide you as you try and picture just amount of money or net worth that you'll need in order for you to fully retire one day, right? And according to the Trinity study, just briefly, for you to figure out how much you need to retire, all you have to do is take your yearly expenses and multiply those by 25, and that is the amount of money that you will need in order to be financially independent, in order to retire. And believe me, that number is going to be so high. It's going to be so high. But keep in mind that it's not just money that you're going to be contributing into some savings account that doesn't earn interest. This is money you're going to be investing, right? Which means that part of that money is actually interest that you're going to earn, capital gains, dividends, things like that that you're going to get from your investments. And as we know, compound interest is such a beauty. It will play in your favor so much in the long run. So just keep that in mind when you look at that number, because it is going to be quite a big number, because we're talking about money that will allow you to retire, allow you to not need to work. So you know, we need to make sure that you have enough money. But that in brief is like a rule of thumb that you can follow to figure out how much exactly you actually need to retire. Once you have that rule of thumb and you feel like you really want to be sure, like really sure, you want to make sure that you talk to like a professional financial planner. They can help you actually figure out how much you need to retire. And most likely they'll also use the rule of thumb as like a starting point for them, right? So that's just something that you need to figure out, is how much you need to retire, so that you know that's just how much you are targeting here. We don't want to be running towards nothing. We want to run towards something, right? So we need the goal, we need to know the numbers, we need to know exactly what the target is. A big question when it comes to financial independence and early retirement is the question of, okay, I have my savings right now, I can save a little bit of money, so where should I actually put this money? As in, which investments should I have? And that's a really good question, because there are so many investments that you could put your money in. There's the stock market, real estate, you can buy livestock, you can buy NFTs, crypto, so much, right? So it's important to figure out, firstly, when you're trying to answer that question, your risk appetite. How risky are you willing to be with your money? Which means asking yourself questions like, how would I feel if my portfolio lost 40% today? Would that make me panic? Would I feel like I need to pull my money out? You know, ask yourself questions like that, hypothetical questions. And I think this current environment, actually in the stock market, is a great way to figure out your risk appetite, because as you see the market drop, you start to realize, okay, am I happy? Am I still fine? Or am I panicking? And that will help you gauge just how risky you're willing to be with the money, or how risk averse you might actually be, right? So First of all, figure out your risk appetite. It will help you decide which type of investments are right for you. There's been so much research about what investment strategies have worked, what haven't over the years. And one of those research studies centers around whether or not it is beneficial to pick individual stocks, or is it more beneficial to actually invest in index funds and ETFs, broad-based index funds and ETFs. And just a brief definition of exchange rate funds. So exchange rate fund essentially is a bucket. It's a bucket where you can find multiple shares in it, and all you have to do is just buy that bucket instead of buying those individual shares. So for example, the S&P 500 has Microsoft, it has Facebook, or Meta now as we call it, and so many other different companies. So when you buy the S&P 500, you're essentially buying 500 different companies within that ETF. That is why it's broad-based, it covers different industries and so on. So that is essentially what an ETF is. If you want to really dig in and understand what an ETF is, I did make a video that you can watch right after this one. You can just click on the little info bar there. So that is essentially what an ETF is. So there have been so many studies that compare ETFs, index funds, to picking individual stocks. And the idea there is when you track an index, when you buy an ETF, because you're so broadly diversified and you've essentially caught the broad stock market, we're essentially investing in whatever the market will return that year, which means you're not trying to beat the market, which is what you're essentially trying to do when you invest in an individual stock. Because when you invest in an individual stock and that particular company does really well, you stand to make a lot of money. Let's say you invest in company A and company A makes so much money that their stock price is worth 400 times what you bought it at. That means you have 400x your money. That is a lot of money, right? But if that company A doesn't do so well, then you actually lose a lot of money, or if they're mediocre, you get mediocre results. Whereas when you're investing in an ETF or in an index fund, the performance of your portfolio isn't dependent on individual companies. It's actually dependent on so many companies that it actually evens out over time. And there's, like I said, there's been so many studies around it, and what's been found is that it's more efficient and it's more profitable to actually invest in broad-based index funds and ETFs than it is to invest in individual stocks. That is not to say that everyone should now invest in ETFs and index funds. No, you have to find what works best for you. But in general, when it comes to the FIRE movement, most people in that movement invest in index funds and ETFs just because, one, it's so easy, two, it's been proven to actually work really well over the long term, and three, it's so accessible because when you buy individual stocks, it's more expensive. If you're going to buy one Apple share, it's going to cost you a lot more than it would be for you to buy and share in the S&P 500. And isn't that interesting? When you get so many companies with S&P 500, but when you buy one Apple share, you're just getting that one Apple share, right? So it makes it so much easier for a lot of people to actually invest and diversify their portfolios. So that is one way of actually going towards financial independence and early retirement. Like I said, there's other different ways of investing. You can invest in real estate, you can invest in house, you can invest in anything really, but you have to come up with an investment strategy that works for you, makes sense for you, and really important to make sure that it is at a level where you are comfortable in terms of your risk appetite, because being able to actually invest continuously in the long term is what's going to build you towards financial independence. And if you get your risk appetite wrong, you risk buying an investment that's way too risky for you and ending up panicking and pulling your money out when it's the worst of times, right? So that is what investing for financial independence at a high level in general looks like. And if you are interested in ETFs, I also have a video where I chat about how you can actually research exchange rate funds. So that is all that I have for today's video. I wanted to just give you guys a few simple things that you need to make sure that you have down in order for you to achieve financial independence. Like I say, this video is in collaboration with Nozi, Talking Money with Nozi here on YouTube. She did a video explaining exactly what the FIRE movement is and how it works, and I was here to explain to you guys exactly how you can actually work towards financial independence as someone who is personally working towards that goal myself. So I hope that you found this information helpful. Leave a comment down below. If you've watched until the end, please leave me a yellow heart emoji. I always love seeing that people watch until the very end. So thank you so much, guys. Have a fantastic day, and here's to your financial independence. Bye. So my point here being, do not villainize. Wow, is that the word? My point here is, do not villain.